Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Chipotle and do a stock analysis on them. Because this stock has fallen over 50% since its highs in the high 60s, down to about $33 today. So, what's been going on with the stock? I'm going to explain why it's been falling, and if it potentially could be a good value now after the 50% drop, or maybe if something has changed and we need to start looking at lower prices. But before we get into the stock analysis, make sure to subscribe to my channel. Balance sheets matter. I do individual stock analysis videos. So if you like looking at individual stocks, want to get good ideas on potential stocks to buy, value traps to avoid, make sure to subscribe to the channel. And if you do want me to look at a stock, leave it in the comments below. And with that, let's take a look at Chipotle now. First thing we can do is look at a few of these like top level metrics here. Sometimes we like looking at basically the group focus value band. And when a company is predictable, this sometimes can be somewhat accurate. And this is saying it could be significantly undervalued, but we're going to analyze that and see if that's really the case. The next thing is right now you can see basically their PE ratio, and the PE ratio is a little bit on the higher side, which can be justified for higher quality companies with good growth rates. And it's currently sitting a little bit above 30, but the forward PE is only sitting at 28.92, which, while that's projecting a little bit of EPS in the growth in the future, that's not very much. And then when it comes to the dividend and buybacks, well, they don't pay a dividend, but they do basically do buybacks, which ends up with about a shareholder yield of 4.66% per year. And if we pop into the financials here, you can see basically the last 10 years, the revenue has grown at 13.7%, where the EPS just might be from a selective time frame when the EPS was a little bit on the lower side, but over the last 10 years, at least, since I know 2016 it was not looking very good for them because their margins were down. It's average 30.96, 30.9, which isn't probably entirely accurate. And if you look at the little chart here, the green line basically shows the analyst estimates, which this is more moderating to about a 10% growth line, where their old historic revenue growth line has been around this 16% in the longer term. So this does show the company basically is slowing down in growth. One of the things we can see, basically look at in them to see if the business is really still, if it's actually slowing down, they're able to keep expanding. So you look at the return on invested capital and weigh it against the weighted average cost of capital. And you can see, like I was saying, during this 2016 time, they did have a little slowdown there where their margins compressed, and they basically have re-accelerated somewhat again. And the return on invested capital now is getting back closer to around 20%, but it's kind of not quite at those previous highs it was before in 2015 at 26%. But honestly, for a fast food type restaurant, or whatever type of restaurant you want to call it, fast casual, somewhat healthy, it's doing pretty well. And their weighted average cost of capital, it's like nice significantly above that, which the weighted average cost of capital is sitting at 8.32%. So we go and basically look at their income statement. And you can see, while the revenue has basically grown quite a bit over the last several years, there has been quite a bit of a slowdown. In 2024 to 2025, the revenue basically barely grew at all. And from the chart we could see above, the analysts are expecting a little bit of re-acceleration for that. So that's one thing you basically have to keep in mind, that the stock price right now is kind of based a little bit on those analyst estimates of that re-acceleration again. When it comes to the gross margin, this basically has fluctuated. Like I said before, about 10 years ago, they did have a reduction in the gross margin. They were sitting before around 26, 27%. And they actually did get back to this 26, 27%, but it actually has gone down a little, and we're down to just a little bit under 25%. And you can see, for example, in the last quarter, it's down to 23.28. And compared to the quarter 1 year ago, that's, quite a big drop from 26.21. And that gets into just a few of the headwinds basically facing Chipotle right now. One of the main ones being that a lot of, other companies have basically noticed, and, consumers themselves, is food costs have been rising. There's been constant inflationary pressures basically on food and beverage, and even packaging, which, do eventually push down margins. And this is one hurdle that everyone, has to overcome, but this will basically at least continue to affect the consumer trends in the short term, as long as it's happening. I think a lot of people right now, it's basically happening with Iran and the Strait of Hormuz, and if that basically stays closed, as you can see right here, it's also highlighting delays in the Middle East due to geopolitical tensions that can keep oil prices high, and that kind of keeps inflationary pressures and prices higher there. And with things like increasing beef that people like, I think a lot of people have seen also the videos that have been running around online of them giving smaller and smaller portions. So that might, be slowing down the revenue growth a little bit, but you kind of have to decide, you give some shrinkflation or you want to really take it in the margins. And this is a decision that every basically company is having to make. Now we can see their operating margins here. The operating margins are actually sitting relatively a lot better at 16.88%. You compare these to, say, 2011 to 2014, this is actually in line with the same operating margin. And their gross margin was basically higher back then, meaning they are actually, from the other operating expenses and selling and general admin, they are keeping their stores quite efficient. So one thing that happens a lot of time, especially with more retail type, storefront based businesses, if the stores are, they're trying to grow through just expansion, but the stores are actually contracting, what you'll see these expenses and the other operating basically expenses rising faster than the overall revenue. But right now, from the longer term perspective, I really don't see that we're seeing that with Chipotle, because, right here, it's like, well, 25%, maybe a bit lower. That's 2.5% lower than they were back, 15 years ago. But the operating margin is maybe only down 1.5%. So this is one good thing, that they're not kind of in the fake growth cycle of trying to grow their stores, but they're compressing down. So we're not seeing that yet, but that is one thing you do have to watch. As we did previously look at here, there are saying that, cost management is one of those things. And if we do look at the last quarter, you can actually see that the operating margin did really get pinched down as well. Well, it did basically drop 3% here. If you actually look at the drop here from the previous quarter, it was a little bit more than 3%, a little bit closer to 3.5%. So this is something you're really going to want to monitor in the future, because basically, if Chipotle does start getting into a little bit more of a operating margin compression cycle and a gross margin compression cycle, that could drive the stock a lot lower. But getting on to the positives, you can see that basically Chipotle has zero interest expense, which is very nice, meaning they have no long-term debt. And they do have a little bit of interest income sitting at about $74 million. But this balances out from the other operating income expense, which typically these are just small write-offs. Sometimes they're real expenses. It's pretty negligible, giving them pre-tax income of just under $2 billion. And since, most of their stores basically are in the States and, I think, Canada and some other places, but primarily the States, that gives them a average tax rate of about, 24%. And as you can see, like a lot of companies, when basically the tax cuts came in from, like, Trump, this actually did heavily benefit a lot of companies, since they don't have to pay as many taxes, and it boosts their earnings, which is at least good for investors. And we can see basically that's giving them a bottom line income of basically about 11-12% right now. So, factoring in the tax thing, we should expect it to be higher than the net margins in the past. And you can see right now our EPS, a little bit over $1 share, not kind of like in at least in the last 12 months, because of this last quarter, which was a little bit of worse, driving things down. And one way they do basically, as we already kind of mentioned, return capital to shareholders is through basically buying back shares. And you can see every year they do consistently basically buy back some shares, which is, really nice to see, because they don't pay a dividend. And typically when the company's not paying a dividend, but they're just doing share buybacks, not only is this one way just to return capital to shareholders, if the company does kind of feel it has a lot more legs of growth behind it, this usually is the more efficient way to do it when you still have growth ahead of you. But from what we've seen so far, with their operating margins not getting really hammered that much, even in comparison to the past, with all the current problems going on basically with the economy in the world, well, that's actually looking pretty good, that they could actually grow at a reasonable pace, maybe not as much as before. And we can basically see on their balance sheet, they're earning that income from a little bit of the marketable securities. So they are sitting on a little bit of, like, nice cash, marketable securities on their balance sheet. That's 1.1 billion. It gives them, just a normal kind of current ratio of close to 1, because the total current liabilities are a little bit basically higher, but some of that is like lease obligations and this and that, and they don't really have any goodwill on their balance sheet, since they don't really do acquisitions. So kind of what we're seeing more on their balance sheet is a little bit more in the tangible aspect, and that is giving them total equity of $2.4 billion. But if I just going to scroll up so I can see the market cap here, you can see the market cap is $42 billion, a little bit over. So that $2.4 billion isn't really a very large factor. So there's really nothing to factor in of garnering a higher PE since they have a lot of equity on their balance sheets. And sometimes you'll find companies they have a lot of equity basically and like real tangible assets and cash compared to their market cap. And that's one reason you would give a company a higher valuation, which we're not really seeing in Chipotle right now. When we get onto the cash flow statement, one important thing I always basically focus on is we look at the cash flow from depreciation and compare it to the purchase of plant, property, and equipment. What we see right now basically is the purchase of plant, property, and equipment basically is consistently higher than the cash flow of depreciation, since this is because Chipotle still is an expanding business, and this is actually something you would want to see in an expanding business. That does basically mean at the end of the day, typically your free cash flow is going to be lower than your net income on average because of this. If we ignore all the other little things of changes in working capital or deferred tax and etc. there. And then, as I was saying, you see no basically purchases of businesses basically happening. There's been some minor sales of plant, like plant property and equipment, but overall, there's virtually no purchase of businesses, and this investment activity is basically just for their marketable securities, probably treasuries buying and selling them, and that's how they're earning that little bit of extra interest with the cash on their balance sheet. And you can see how they're returning share capital to shareholders through the share buybacks, which they have more started aggressively upping in the recent years, with actually quite a bit at $2.5 billion in the last year. And the one thing basically I like to see with Chipotle here is this does look a little bit more strategic on the share buyback, since they do have marketable securities and cash. They can go and spend basically if they want to repurchase stock, and at least they're buying it right now in 2025 versus as much in the previous years when the stock was a lot higher in price. And even 2016, you can actually see the same pattern. And 2016, when the basically stock was down, they actually did buy back a little bit more than average, repurchase a stock there. So this is one thing that I think management is doing well, is they are kind of more strategically buying back more stock when it's basically the prices are a little bit relatively lower. It's not going to be perfect, but it's better than companies that basically cut their share buybacks when the stock is really low, but have a lot of share buybacks when the stock is really high, at least from a long-term perspective. And just like on the stock front, you should look at basic stock-based compensation. It has marginally been creeping up, but $100 million of stock-based compensation compared to the $2.5 billion of repurchase of stock is very, very minimal. And you can see they got nice positive cash flow. So overall, like Chipotle as the company and the financials itself are sitting really good. It's basically no real risk of bankruptcy. They could handle any type of downturn, and they're probably going to be able to get out of it pretty good. And they do have a little bit of basically excess capital sitting on their balance sheet where they can deploy and buy a few more shares back, if things basically get hit a little bit more. But let's jump into the interactive chart now, get an idea for the valuation or the relative valuations I like to usually look at. And you can see this is based on the analyst estimates, and you can see basically right now they are expecting it to decrease, and this is on average about a 10% rate with potentially a little bit of slower growth in the future. So compared to the past, like I'm actually going to just bring up just to kind of show how much actually is happening year over year. Revenue growth per share. That's probably what we want to look at here and get this there. And I think this kind of does help illustrate it a little bit better, because you can see right now it's been a little bit lower than the average last year at basically revenue growth per share is at 8% because of factors and buybacks. But these previous years, okay, you're 15, 16, 25, and 25 was this really high one here. It was down to a 6. It was a little bit lower, 13. But on average, and especially pre-2016, they were averaging like over 20%. So it is like looking like they are potentially slowing down a little bit. And this, this happens when you get larger. You can only expand so fast. You can't expand 20%, 20%, 20% per year indefinitely. Well, it seems like some companies can, like Google, but that's not normally the most normal thing, and it eventually does slow down. And we can look at price to sales ratio, and you can see, like, relatively speaking, it's obviously a lot lower than the very high price to sales ratios up here. But even from a historical perspective, when growth rates were a lot higher, this isn't actually that particularly low. When they did have their previous margin slowdowns before in 2016, 2017, it actually went down to a 2. And we're sitting actually, quite a bit above that. And it's still quite a bit above 2009. So this is definitely leaning towards this is not, rock bottom prices yet. And so if we bring up the margin, and I just want to show basically the operating margin, we can ignore the tax net one since that kind of includes the tax. And you can see the operating margin. They were able to, get it back up to these levels, but this probably is a limit on what they're going to be able to basically have on the high side. And with the current pressures they've been facing, if those do continue, this can basically mean it can go down. And from the comparative perspective of the price to sales ratio, just from a margin perspective before, there certainly is room for them to drop if the margins were to be compressed even in the short term a little bit more, but they're definitely not on an increasing cycle at all anymore. And we can bring up the PE ratio, and you can see right now they're still sitting, like we said, at a 30 PE. And like historically, they've always traded kind of expensive. Oops, let me just bring this all back up here. 30 years. There we go. And, the thing is, some of these stocks that are high quality stocks, but Chipotle is a high quality stock, when they're growing quickly and the market sees the margin expansion. Remember, margins were really low in 2016, 2017. And then along with the good revenue growth were happening, the margin expansion, that did get to some crazy PEs. And even if we ignore the kind of ones here just basically after 2020, we can see they were trading at a 60 PE, a 50 PE, a 66, which, frankly is quite extreme. And this is what happens to a lot of stocks. They get in these cycles that are very positive for the revenue growth and a little bit of operating margin expansion. But even from the longer term perspective, Chipotle was just recovering their operating margins back to what they previously were. It wasn't even a longer term perspective. But typically, how the market and the institutional investors do, they apply basically a very high premium to that because it's kind of projected out, hey, that may basically continuing happening in the future. And I definitely see right now that is not happening with Chipotle. And if potentially, best case scenario, it's going to be kind of like a little plateau or even some contraction. And right now we're sitting at a 30 PE, and relatively speaking, this has been, kind of a relatively lower PE for it. But you have to remember, in these previous years, the company was a lot smaller and they were growing a lot faster. So I really don't actually think that's, very attractive PE anymore. And I would be looking something more because they are a higher quality company. They still are basically planning on growing at 10% growth rate in the future. Maybe a 25 is more of a fair PE, which, that could mean they're going to be trade on the low side to a 20 and the high side maybe to a 30 or low 30s in the future, but definitely not this 30 to 60 going forward. And you can see that would garner them a lower price going forward. And if we do bring up basically the chart here for a little bit of technical analysis, I'll just kind of show my thing where I have basically these two different channels here. And this was the old rate before, which kind of, if you took their share buybacks along with the revenue growth, that's about what it was. And if they're, doing around 10% growth and they, have a higher share buyback yield because the PE is lower, this is kind of, I think, realistic. They could be on the 17%, kind of growth for at least the foreseeable future if the current analyst estimates of this 10% kind of growth go forward in the future. You can kind of see how the chart, this old channel here, this one, this is what they were riding at, but then they didn't reach the top channel again. And I think what's happening is how I like at least do it from a technical and fundamental perspective. I kind of find this new trend they're potentially forming. And in my opinion, this new trend is going to be at this little bit lower rate here. And I typically try to want to, get the stock when it's a little bit more cheap. So when I would next be basically looking at Chipotle would probably be around this low $20 price range. And if we do look at the monthly for this even from a moving average perspective, this is where they bottomed basically before on the moving average when they had the previous margin compression as well. So this doesn't mean necessarily just jump out and buy it then. You got to see what else is happening, since if there is more deceleration, that actually could mean and garner lower prices. But this is kind of the point I currently would be looking at Chipotle, start getting a position in it. It was basically the under $25. And even based on their earnings, which originally they gapped up and the market seemed to respond kind of positively to it. As you can see right here, there was a gap up, a gap basically up like 6.5%, but it's faded back all of those gains, and that's not a good sign for a stock. Like when you get the little gap up and immediately the market fades it, and I think right now the last few days the market's been like not in the big sell-off mode at all. It does tell you a little bit where the heads of the institutional investors and the big money are. So this basically stock does kind of appear to be continuing, at least in the short-term downtrend. You can kind of see at the shorter term where it is. Once it gets to more than $24 range, that's where I think it's potentially a little bit more attractive, and just a little bit more on the technical analysis. If you kind of really want to buy some actual capitulation, you can look at something like RSI, and you kind of look where here there's a really aggressive drop. Well, there was more downside. When it then do a second drop and broke a lot lower there, that was kind of not necessarily marking the bottom, but the start of the bottom where you got a little bit of positive divergence before it started breaking up. So maybe that's something we're going to basically want to keep our eyes out in the future, since a lot of the times when these stocks do get a little bit oversold and you're actually at a good valuation, that can be a good combination for a bottom. You can see kind of the same thing happened here in 2008, 2009. It hit the bottom, still kind of just chopped sideways while the RSI trended a little bit higher. So that's another kind of technical signal you can kind of loosely use to see if Chipotle kind of really actually does get that capitulation. And then maybe after that you wait basically a few weeks, couple months, and you buy it before it potentially starts an uptrend, assuming there isn't more headwinds causing their net margins to collapse. Since if the net margins collapse and they project forward they're going to collapse more, well, the market's going to want it potentially cheaper. And I'll just kind of go from this technical front again here. So let me try to I'll just get a line or something. You do have all the big price volume profiles here, and you do have other levels that can start coming into play at these lower prices and ignore this little trend that I'm just kind of making up right now as something that potentially could happen based on the estimates that are currently we're seeing right now. And if this type of trend were to occur, along with basically the 17% per year, kind of a reversion back to the mean would also be just 100% upside if you were to be able to buy at 24. Those analyst estimates basically come true at $24. Probably in at least by the end of next year, fair value would be a lot closer to 50, in my opinion. And then on top of that, you have kind of your 17% a year up drift. So anyways, I think overall Chipotle is a high quality stock. I've said this a lot of others like Lululemon as well, but when their growth trend starts basically slowing, you can't look at the old valuations they were given, and you have to realize that not all these stocks trade at high valuations forever. And this goes for a lot of the other stocks in the market I'm not talking about, like the semiconductors and tech companies. They don't necessarily trade at these really high PEs forever. You can have little slowdowns happen and the market will reprice them very quickly. And I think that's basically what's happening in Chipotle right now. It's in a repricing. It's not going to get completely slammed down as much as Lululemon, where Lululemon's really decelerated in their growth. Chipotle is just moderately decelerating in their growth as far as we can see currently. And this is why you need to basically go make sure to subscribe, get the updates for the channel, so when we look at the stock again, you can see what's basically changed, or look at it yourself. But I hope you liked the video. Make sure to like the video, subscribe to the channel, and I'll see you in the next stock analysis.